Imagine this. You wake up tomorrow, gas is $9 a gallon, flights are canceled, your grocery bill is 30% higher, and the stock market just dropped 1,200 points. No warning, no recession announcement, just headlines. US-Iran conflict escalates. The scary part? This chain reaction could happen in days. But here's what most people don't understand. It's not the missiles that crash economies. It's oil. And I'll show you exactly why. The trigger nobody talks about. There's a narrow strip of water called the Strait of Hormuz. It doesn't look important, but nearly 20% of the world's oil passes through it. If that route becomes unsafe, oil doesn't rise slowly, it explodes. And when oil explodes, everything else follows. But here's the part most YouTube videos won't tell you. High oil doesn't hurt everyone equally. Some people actually get richer. We'll come back to that. The domino effect. Let's walk through this slowly. Oil goes up, transport costs go up, food costs go up, manufacturing costs go up, airline tickets go up, inflation spikes again. Now central banks panic. The Federal Reserve might delay rate cuts, which means mortgages stay expensive, credit card rates stay brutal, business loans stay tight, and growth slows. But here's the dangerous part. If inflation comes back after people thought it was under control, markets overreact, and that's when volatility hits. Market panic. Let me ask you something. If the market drops 15% in 1 week, are you selling or buying? Be honest, because during geopolitical shocks, investors move money into gold, oil, US dollar, energy stocks spike, defense companies rise, travel stocks fall, tech becomes unstable. But here's the twist. Historically, markets often recover faster than the news cycle, unless the conflict drags on. And that's where things get serious. The scenario that changes everything. Short conflict, markets dip, oil spikes briefly, life stabilizes. Long conflict? Now we're talking about shipping insurance skyrocketing, supply chain rerouting, energy shortages, persistent inflation. That's when recession risk rises globally. And if oil touches $120 to $150, consumer confidence collapses, spending slows, hiring slows. That's when unemployment risk increases. But wait, there's something even more important than oil, and almost nobody talks about it. The psychological shock. The real danger isn't prices, it's fear. When people feel uncertain, they stop spending. Businesses stop investing, companies freeze hiring. Economic slowdowns often begin in the mind, not the market, which means perception becomes reality. And that's why media coverage matters more than missiles. Who actually wins? Every crisis redistributes money. Winners? Oil producers, defense contractors, energy exporters. Countries dependent on energy imports? They struggle. Consumers? They feel it daily. But here's the opportunity most people miss. Volatility creates asymmetric opportunity, if you're prepared. What smart people do? If geopolitical tension rises, 1. Strengthen emergency fund, minimum 3 to 6 months. 2. Avoid new high-interest debt. 3. Don't panic sell long-term investments. 4. Keep cash ready for opportunity. 5. Focus on income stability over speculation. The worst financial decisions happen during emotional spikes. Preparation beats prediction. But here's the truth. Most wars don't become global economic disasters. Markets price fear fast, and they recover faster than headlines. The real risk? Overreacting. If you panic sell at the bottom, you lock in the damage. If you stay calm, you often survive it stronger. Geopolitics moves oil. Oil moves inflation. Inflation moves interest rates. Interest rates move markets. And markets move your money. You can't control the conflict, but you can control your position. The question is, when the next headline drops, will you panic or will you be prepared? Subscribe if you want to understand money before it moves.